Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Molson Coors stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Molson Coors is a drink and brewing company headquartered in Chicago. The company was formed in 2005 through the merger of Canadian company Molson and American company Coors. In 2016, it acquired Miller Brewing Company for $12 billion. After the acquisition, Molson Coors became the world's third largest brewer. Let's get started with the model. This is a large cap company, $11 billion market cap. They're trading at $51 a share, and they have 217 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company has pretty consistent free cash flow each year. It ranges from $1.3 billion to $1.7 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. It's $1.4 billion in 2017 and then $600 million in the trailing 12 months. Revenue is a sales for the company, and that was $11 billion in 2017, but it's much lower in the trailing 12 months at $9.8 billion. A lot of restaurants, bars, they're closed down due to COVID. This is the company's income statement. The top line is the revenue, the sales. Below that is their cost of revenue. That's around $6 to $6.5 billion a year. And the difference between those two numbers is their gross profit. That was $3.8 billion in the trailing 12 months, its lowest number. Below that is operating expenses, and then below that is operating income. So it does appear the company is doing a good job at managing their expenses because their operating income was higher in the trailing 12 months when compared to 2018 and pretty similar to 2019, and they had much lower revenue. Below that is the interest they pay in their debt. That's $275 million. Then below that is other income and expenses. When a company makes money or loses money outside of its core operations, that goes into other income and expenses. Then you have your pre-tax income, then taxes. So the company does have positive net income every year. It did peak in 2017. The main reason their net income was lower in 2019 and the trailing 12 months was due to the other income and expenses. These are probably impairments they passed through. That's why I would focus on operating income when I look at a business, because anything below that can really skew their numbers. This is the company's statement of cash flows. The top line is operating cash flow. That's around $2 billion a year. Then you have capital expenditures, which are investments in property, plant, and equipment. If the company wants to buy a new factory to start manufacturing more beer, the cost of the factory would go into CapEx. They would capitalize that dollar amount on the balance sheet and pass through a depreciation expense each year. This company is doing a really good job at shedding its debt. It paid down $3 billion of debt in 2017 and issued $1.5 billion. Then the following years, it pretty much issued no debt and paid down a decent amount of debt. This is not very common. Most companies I look at are adding debt. They're lowering their debt. And the reason they're able to do this is because they have positive free cash flow each year. The way you calculate free cash flow, it's operating cash flow minus CapEx. So they have over $1 billion a year to work with. They could pay down debt, which is what they were doing, or they can invest back into their business. They could also pay a dividend with the free cash flow, but they cut their dividend in 2020. The most important part of any business is their operating cash flow. If you cannot generate positive and healthy operating cash flow, you don't have much of a business. And this company definitely generates a good amount of operating cash flow. And the way you calculate that, you start with net income, that was $600 million. Then you have to add or subtract the non-cash items on the income statement. They had a $930 million depreciation expense, $305 million of deferred taxes, and other non-cash items. Plus, they had a positive $340 million in changes of working capital. So if a company uses accounts payable, that will increase their working capital, which increases their cash flow. But when they have to pay the accounts payable back, that will decrease their cash flow. So even though the company reported $600 million of profit, they actually generated $2.1 billion of cash flow. Let's look at a capital structure. $14 billion of equity, $9 billion of debt. So they're 60% equity, 40% debt. And their WACC is 7.3%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $29 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $27 billion. We divide that by 217 million shares. And we get a calculated stock price of 122. They're trading at 51, so they're trading at a 59% discount. It's a buy according to the model. Simply Wall Street's at 104 a share, so they're also saying the stock is undervalued. The stock was trading over $100 a few years ago, but it keeps coming down in price, so it looks like it's at a really good value if you feel the future of the company is going to be strong. Of course, as you know, the stock price is not based off of how well a company's doing, it's based off of supply and demand of the market. So if the market feels the stock price will go up, they'll push the price higher. If they feel the stock price will go down, they'll push the stock price lower. In 2020, the company announced they're cutting their dividend. They have a beta of 1.16, so the stock moves a little more than the market. The stock has gone down 10% in the past 52 weeks, much worse than the S&P 500, which went up 17%. The low was 32, the high was 62. And the stock is trading above its 50-day and 200-day moving average, so it seems to be on an uptrend. About 2 to 2.5 million shares are traded each day for this stock, and almost all the shares outstanding are on float. They actually have 217 million shares outstanding. Yahoo Finance has an incorrect number. About 87% of the shares are held by institutions, so they're bullish on this stock. And about 7.5% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $13,200. If you did not reinvest the dividends, you'd have $13,400. Not much of a return on investment. But you could have sold at its peak at over $20,000. Of course, hindsight is not 20/20. If it was, we'd all be rich. Dodge & Cox owns the most stock at 14%, then Vanguard, BlackRock, State Street. The trust fund for the original founder, Adolf Coors, owns 4% of the stock. Let's look at the financial ratios. The average PE in the market's 11.3, the median is 14.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 18.8, so investors are paying about $19 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.1, much better than the median and average. Price to book is stock price over book value per share. They're at 0.8, a lot better than the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on a balance sheet, and they have $14 billion of equity, negative $8 billion of tangible equity. They have $21 billion of intangible assets on their balance sheet, $7 billion of goodwill, and $14 billion of other. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 5 times. ROE is net income over equity. They're only at 4%, which is worse than the median and average. Current ratio is current assets over current liabilities. They can only cover 60% of their current liabilities with their current assets. And their current assets are $500 million of cash, $800 million of receivables, and $600 million of inventory. So the company may need some debt to get through the next 12 months. They did have positive free cash flow, but they have negative $1.5 billion of working capital. So it really depends on how much cash they generate in 2022. The best way to look at ratios to compare them to similar companies, I've done videos on Anheuser-Busch, FEMSA, and both in the same industry as Coors. And if Coors has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're a little worse in PE. They're better in price to sales and price to book. Current ratio, they're doing terrible. They have the worst ROE. They're doing okay in debt, 40%. They're in the middle. They're the smallest of the 3 companies, 11 billion market cap. Bud is 92 billion, much bigger. And they don't pay a dividend. So to summarize, I do have them trading at a 59% discount because their stock price keeps going lower and lower, so it appears more attractive. I ranked their free cash flow as 7 out of 10. It was 1.5 billion. It increased 19% in 4 years. Their revenue I ranked 6 out of 10 9.8 billion is okay, but it's down 11%. The ratios are pretty good, 7 out of 10. They do have good products, 6 out of 10. I think they have a pretty strong brand image, so I gave them 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.